welcome and settle in. Tonight we're embarking on a journey together, one that will transform the way you think about money, the way you relate to your finances, and ultimately, the way you build the life you've always wanted. This isn't just another lecture about spreadsheets and sacrifice. This is about reprogramming your deepest financial habits while you rest, allowing new patterns to take root in your subconscious mind as you drift into peaceful sleep. The room around you is comfortable, the lighting is soft, and you're exactly where you need to be. Let your body sink into whatever surface supports you right now. Feel the weight of the day beginning to lift, like a heavy coat sliding off your shoulders. As we move through this exploration together, your conscious mind might wander, might drift, might even fall asleep entirely, and that's perfectly fine. In fact, it's ideal. Because the real work happens beneath the surface in those quiet spaces where your beliefs about money live, where your habits were first formed, and where they can be gently, permanently reshaped. Your relationship with money didn't start when you opened your first bank account or earned your first paycheck. It started much earlier, in 1,000 small moments you might not even remember. The way your parents spoke about bills at the dinner table, the feeling in your stomach when you wanted something but were told you couldn't have it. The first time you saved coins in a jar and watched them accumulate. Or perhaps the first time you spent everything you had and felt that particular emptiness afterward. These moments created neural pathways, established patterns, built the foundation of your financial blueprint. And here's what's beautiful about the human brain. It's remarkably plastic, meaning it can change, rewire, and create new pathways at any age. Tonight, as you rest here, listening to these words, your brain is already beginning that process. You don't have to force anything. You don't have to memorize formulas or stress about whether you're doing it right. You simply have to allow yourself to absorb these concepts. Let them wash over you like gentle waves, and trust that they're finding their way into the deeper layers of your consciousness. Think about how you learned to walk. You didn't study a manual or analyze the biomechanics of bipedal movement. You simply watched, tried, fell, got back up, and eventually, without even thinking about it, walking became automatic. Your financial habits can become just as automatic, just as natural, just as effortless. The difference is that now, as an adult, you have the advantage of understanding the why behind the how. You can consciously choose which patterns to reinforce and which ones to release. The science supports this approach. Research in behavioral economics has shown that our financial decisions are rarely purely rational. They're influenced by emotions, past experiences, cognitive biases, and deeply ingrained beliefs that operate below the level of conscious thought. Traditional budgeting advice often fails because it speaks only to the rational mind, trying to override these deeper patterns through willpower alone. But willpower is a finite resource, exhausted by the end of each day. What we're doing tonight is different. We're speaking directly to the part of your mind that doesn't need willpower, the part that simply is, that accepts new truths and integrates them seamlessly into your behavior. Studies in neuroplasticity have demonstrated that the brain is particularly receptive to new information during states of relaxation and during sleep. The theta brain waves present during deep relaxation, and the initial stages of sleep create an ideal environment for learning and memory consolidation. Your mind right now, as you lie here in this peaceful state, is more open to transformation than it might be at any other time during your day. The usual defenses, the usual skepticism, the usual "but what about?" questions that arise when you're fully alert, these begin to quiet down, allowing new possibilities to take root. So as we journey together through the landscape of budgeting and saving, through the architecture of wealth building and the psychology of financial security, know that you're not just learning information. You're undergoing a gentle, profound reprogramming. And when you wake tomorrow morning, you might not consciously remember everything we've discussed tonight. That's okay. The important changes will be there, woven into your decision-making, present in your choices, reflected in your relationship with money. Let's begin with where you are right now, with compassion and honesty, because transformation can only begin from a place of truth. Your current money. Blueprint. Understanding the foundation. Every person walking this earth carries within them a money blueprint, a set of unconscious beliefs and automatic responses related to finances. This blueprint was drawn up long ago, sketched out through experiences, teachings, and observations that happened before you even knew what money really was. And the interesting thing about blueprints is that they operate invisibly. You don't see them directing your choices, but they absolutely do. They're the reason you feel that particular tightness in your chest when you check your bank balance, or that rush of temporary relief when you make a purchase, or that nagging voice that tells you saving is impossible, pointless, or something other people do. Understanding your current blueprint isn't about judgment. It's not about labeling yourself as good or bad with money, responsible or irresponsible, a saver or a spender. Those labels are too simple, too rigid, and ultimately unhelpful. Instead, it's about recognition. It's about shining a gentle light on the patterns that have been running on autopilot and asking with curiosity rather than criticism, where did this come from? Is it serving me? And if not, what would I rather have in its place? Consider for a moment your earliest memory involving money. Don't force it. Just let whatever comes up, come up. Maybe it's standing in a store, looking at something you wanted desperately and hearing a parent say, "We can't afford that." Maybe it's the excitement of birthday money, those crisp bills that represented possibility. Maybe it's something darker, overhearing arguments about debt, sensing the fear and tension that money can bring into a household. Or perhaps your early experiences were positive, characterized by abundance and generosity, teaching you that money flows easily and there's always enough. These early experiences created neural patterns, actual physical pathways in your brain that fire whenever you encounter financial situations. If money was associated with stress, your nervous system learned to activate its stress response when dealing with finances. If money was scarce, your brain developed heightened vigilance around spending, creating either excessive frugality or, paradoxically, a spend it while you have it mentality born from the belief that it won't last anyway. If money was abundant, you might have developed ease around it, but possibly also a lack of awareness about its limits and rhythms. Research conducted by psychologists studying money attitudes has identified several distinct money personality types, though most people are a combination of several. There's the money avoider, someone who feels uncomfortable thinking about or dealing with finances, often procrastinating on financial tasks and preferring to remain somewhat in the dark about their actual financial situation. There's the money worshipper, who equates financial success with personal worth, believing that having more money will solve all problems and bring happiness. There's the money vigilant, someone who's alert to financial risks, tends to save rather than spend, and feels anxious about not having enough. And there's the money status seeker, who uses spending as a way to demonstrate success, often leading to living beyond means to maintain appearances. None of these is inherently wrong. Each represents a strategy developed to navigate the complex emotional landscape around money. But each also has its shadow side, its potential to create problems. The avoider might miss important financial opportunities or end up in difficult situations through neglect. The worshipper might sacrifice relationships, health, or happiness in pursuit of wealth. The vigilant person might never enjoy the fruits of their careful planning, always waiting for some future disaster. The status seeker might trap themselves in a cycle of debt and comparison. As you lie here now, you might find yourself recognizing elements of your own money blueprint. You might see how certain childhood experiences created certain adult patterns, and that recognition itself is valuable because awareness is always the first step toward change. But let's go deeper, because beneath these patterns lies something even more fundamental. Your mindset around scarcity and abundance, the scarcity-abundance spectrum, rewiring your financial worldview. At the core of every financial decision you make, at the root of every money habit you have, lies a fundamental belief about the nature of resources in the world. This belief exists on a spectrum between two poles, scarcity and abundance. And where you fall on this spectrum influences everything from how much you save to how you feel about others' success, to whether you believe financial. Security is even possible for someone like you. A scarcity mindset, as defined by researchers in psychology and behavioral economics, is the belief that resources are limited, that there's never quite enough, that getting your share means someone else loses theirs. It's the white-knuckled grip on what you have, the constant fear of loss, the inability to celebrate others' wins because it feels like their success diminishes the pool of success available to you. This mindset creates a particular kind of stress, a perpetual low-level anxiety that colors every financial interaction. What's fascinating and somewhat counterintuitive is that a scarcity mindset doesn't necessarily correlate with actual scarcity. Someone can have substantial savings and still operate from scarcity, never feeling like they have enough, always worried about catastrophic loss. Conversely, someone with very little can operate from abundance, trusting that their needs will be met, that opportunities will arise, that there's enough flowing through the world for everyone, including them. The research of psychologist Sendil Mullainathan and economist Eldar Shafir has demonstrated that scarcity itself, the actual experience of having too little of something we need, whether time, money, or other resources, creates its own psychology. It narrows our focus, creating what they call tunneling, where we become so fixated on the immediate lack that we can't see creative solutions or longer-term strategies. A person experiencing financial scarcity becomes hyper-focused on making it through today, this week, this month, making it extremely difficult to engage in the kind of planning and saving that would improve their long-term situation. But here's where it gets interesting. Even after the actual scarcity passes, the psychology often remains. Your brain having learned that resources are scarce and that survival requires constant vigilance, doesn't immediately relax when circumstances improve. This is why people who grew up in poverty might struggle with spending or saving even after achieving financial stability. Their money blueprint was drawn during scarcity, and it takes conscious effort to redraw it. An abundance mindset, on the other hand, is characterized by the belief that there's more than enough to go around, that opportunities are plentiful, that one person's success doesn't diminish your own prospects. People operating from abundance tend to be more generous, more willing to take calculated risks, more resilient in the face of setbacks because they trust that other opportunities will arise. They see money not as a finite pie to be divided, but as something that can expand, that flows, that circulates. Stephen Covey, who brought the terms scarcity and abundance mindset into popular consciousness, described people with the scarcity mentality as seeing everything in win-lose terms, while those with an abundance mentality could see win-win possibilities. This affects not just major financial decisions, but daily interactions. Do you resent a coworker's raise because it means less available for you? Or do you celebrate it as evidence that good things happen in your workplace? When you hear about a friend's financial success, does it inspire you or depress you? These reactions reveal where you sit on the scarcity-abundance spectrum. Now, as you rest here, imagine what it would feel like to operate from true abundance. Not reckless abundance, not ignoring practical realities, but a calm, grounded sense that there's enough that you can save for the future without panic, that you can spend on things that matter without guilt, that money is a tool, neutral and available, rather than a source of constant stress or the solution to all problems. Imagine your nervous system relaxing around finances, your decision-making becoming clearer, your relationship with money transforming from one of fear and grasping to one of thoughtful stewardship. This transformation from scarcity to abundance isn't about denying current challenges or pretending everything is perfect. It's about shifting the fundamental operating system through which you view financial reality, and that shift happens through repeated exposure to new thoughts, new perspectives, new ways of relating to money. It happens through what you're doing right now, allowing these ideas to permeate your consciousness as you relax into sleep. Behavioral economists have found that our financial decisions are heavily influenced by something called mental accounting, the way we categorize and think about money. Someone operating from scarcity might see every dollar as precious and irreplaceable, leading to either hoarding or, paradoxically, quick spending before it can be taken away. Someone operating from abundance might see money as renewable, as something that comes and goes in natural rhythms, which allows for both thoughtful saving and guilt-free spending within planned parameters. The journey from scarcity to abundance often involves confronting deeply held beliefs. People like me don't get to have financial security. I'm just not good with money. I'll never earn enough to save. Money always slips through my fingers. These beliefs feel true because they've been repeated so many times, reinforced by experiences that seem to confirm them. But they are not immutable facts about reality. They are stories, and stories can be rewritten. Recent studies in financial therapy have shown that addressing these underlying beliefs is often more effective than simply providing financial education. Someone can understand compound interest intellectually, but still not save. because their deeper belief is that saving is pointless, or that they'll inevitably face some crisis that wipes out their savings anyway, the conscious understanding is overridden by the subconscious conviction. So tonight, as these words wash over you, let's plant new beliefs. Or rather, let's water the seeds of beliefs that may already be present but haven't been given permission to grow. You are capable of understanding and managing money. Financial security is available to you. There is enough. You can learn new habits. Your past financial patterns don't have to be your future. Money can be approached with calm rather than chaos, with planning rather than panic, with abundance rather than scarcity. These aren't just empty affirmations. They're invitations to notice and reinforce the moments when these statements are already true. Because they are true, even if only in small ways right now. And small truths, when nurtured, grow into larger realities. The architecture of effective budgeting. Building your financial framework. Now that we've explored the psychological foundation, let's construct the practical framework that will support your financial life. Think of a budget not as a restriction, but as a tool of freedom, a way of ensuring your money goes where you truly want it to go rather than disappearing into a fog of unconscious spending. A budget is simply awareness made concrete. It's a plan. And when you have a plan, you can relax because you know where you stand. There are several popular budgeting methods, and what works beautifully for one person might feel constraining or confusing to another. The key is finding the approach that matches your personality, your circumstances, and your goals. Let's explore the most effective frameworks, and as we do, you might feel drawn to one in particular, or you might sense how you could combine elements from several into your own unique system. The 50-30-20 rule is perhaps the most accessible starting point for budgeting. It's straightforward and flexible, making it ideal for those who want guidance without excessive complexity. In this system, you divide your after-tax income into 3 broad categories. 50% goes to needs, the essentials you absolutely must cover: housing, utilities, groceries, insurance, minimum debt payments, transportation. These are your 4 walls, as some financial experts call them, the things that keep you alive and functioning. 30% goes to wants, the things that make life enjoyable but aren't strictly necessary. Dining out, entertainment, hobbies, subscriptions, vacations, the nice-to-haves that add richness to existence. This category is often where people feel the most guilt, but wants aren't frivolous. They're part of being human. The question isn't whether you should spend on wants. It's whether you're spending intentionally on wants that truly matter to you rather than mindlessly on things that don't bring lasting satisfaction. 20% goes to savings and additional debt payments beyond minimums. This includes emergency fund contributions, retirement savings, saving for specific goals, and accelerated debt payoff. For many people, this 20% feels impossibly high when they first encounter the rule, and that's okay. It's a target to work toward, not a requirement for day one. If you can only manage 5% right now, start there. Progress, not perfection. The beauty of the 50-30-20 framework is its simplicity. You don't need to track every single transaction or create dozens of categories. You simply need to ensure that your spending roughly aligns with these percentages. Some months, you might be at 45% needs and 35% wants. Life isn't perfectly tidy, and that's fine. The framework provides guideposts, not prison walls. Zero-based budgeting takes a different approach, one that appeals to people who appreciate detail and control. In zero-based budgeting, every single dollar of your income is assigned a job before the month begins. You take your expected income and allocate it completely. This much for rent, this much for groceries, this much for gas, this much for savings, this much for the electric bill, and so on, until you reach zero, not $0 remaining in your account, but zero unassigned dollars in your budget. The philosophy behind zero-based budgeting is that money without a purpose tends to vanish. By giving every dollar a job, you're making conscious choices about your priorities. If something unexpected comes up, you don't just spend outside the budget. You adjust the budget, moving money from one category to another, maintaining that awareness of trade-offs. Want to spend $50 on something unplanned? Fine. But it comes from somewhere. Maybe you reduce your eating out budget or your entertainment budget for the month. This method requires more time and attention than 50-30-20, but for people who feel out of control with their spending, or who really want to maximize every dollar, it can be transformative. It creates a kind of financial meditation, a practice of regularly sitting down with your money and making deliberate decisions rather than operating on autopilot. The pay yourself first approach flips traditional budgeting on its head. Instead of saving what's left after spending, you save first, automatically moving money into savings and investment accounts as soon as you get paid, and then live on the remainder. This method recognizes a fundamental truth about human nature. We tend to spend whatever is available in our checking account. If you wait until the end of the month to save, there's often nothing left to save. But if you've already moved that money before you have a chance to spend it, you adapt your spending to the reduced amount available. Pay yourself first works particularly well when combined with automation, which we'll explore in depth shortly. The psychological effect is powerful. You're treating savings as a non-negotiable expense, as important as rent or groceries. You're prioritizing your future self, acknowledging that their needs matter as much as your present self's needs. Over time, this builds both your savings balance and your identity as someone who saves, someone who plans, someone who takes their financial future seriously. The envelope system, in its traditional form, involves stuffing physical cash into envelopes labeled with different spending categories: groceries, gas, entertainment, clothing. Once an envelope is empty, you're done spending in that category until the next budget period. This system creates a tangible, visual representation of limits. There's no abstract number on a screen. There's physical money you can see diminishing. In our increasingly cashless society, the original envelope system has become less practical, but the principle remains sound, and many budgeting apps now offer digital envelope features. The key insight is the power of creating clear boundaries. When you know you have $100 for dining out this month and you can see that number going down with each restaurant meal, you make more conscious choices. You savor that meal more. You might decide to cook at home some nights because you want to preserve your dining out budget for a special occasion. Each of these methods works. None is objectively superior. The question is which resonates with you, which you can see yourself actually using month after month, because consistency matters more than perfection. A simple budget you stick with beats an elaborate budget you abandon after 2 weeks. As you drift deeper into relaxation, imagine yourself using one of these frameworks. See yourself sitting down, perhaps once a week or at the start of each month, looking at your income and expenses, making thoughtful allocations. Feel the calm that comes from knowing where your money is going rather than wondering where it went. Notice how this practice, repeated consistently, becomes easier, more natural, until it's simply part of your routine, like brushing your teeth or making coffee in the morning. The budget itself isn't the goal. The goal is the sense of control, the reduction in financial anxiety, the ability to make choices that align with your values and aspirations, rather than just responding to impulses and obligations. The goal is freedom, and the budget is the map that helps you get there. The power of automation. Making good choices effortless. Here's a truth about human behavior that behavioral economists have confirmed through countless studies. We are terrible at sustaining effort that depends on willpower alone. Willpower is a limited resource, depleted by stress, decision fatigue, and emotional strain. You might wake up Monday morning determined to transfer money into savings every week. But by Friday evening, after a challenging workday and a dozen other decisions, that determination falters. You forget, or you rationalize that you'll do it next week, or you see something you want to buy instead. This is where automation becomes not just helpful, but transformative. Automation removes the need for willpower. It makes the right choice, the default choice. And in doing so, it eliminates the daily battle between your present self, who wants to spend, and your future self, who needs you to save. When their money moves into savings automatically before you consciously decide what to do with it, saving becomes effortless. Let's explore the various ways you can automate your financial life, creating a system that works quietly in the background, building your wealth while you focus on living your life. The foundation of financial automation is often direct deposit splitting. Most employers who use direct deposit can divide your paycheck between multiple accounts. You might direct 80% to your checking account for regular expenses and 20% to a savings account. That 20% never hits checking, never becomes part of your available balance, never tempts you. If your employer doesn't offer split deposit, or if your income comes from multiple sources, you can set up automatic transfers through your bank. Most financial institutions allow you to schedule recurring transfers from checking to savings on specific dates. The key is timing these transfers to happen shortly after you get paid, typically within a day or two. This way, the money moves while your account balance is still robust, reducing the temptation to spend it first. The amount you automate matters less than the habit of automating. If you can afford to automatically save 20% of your income, excellent. If you can only manage 3% right now, that's a starting point. The important thing is establishing the system, creating that neural pathway that says, when I get paid, money automatically goes to savings. As your income increases or your expenses decrease, you can adjust the automatic transfer amount, but the habit, the system, remains constant. Beyond basic savings automation, consider automating your bill payments. Late fees are wealth killers. Hundreds of dollars vanishing each year simply because you forgot a due date or were traveling or got busy. Most bills can be set to autopay, either directly from your checking account or via a credit card that you then pay off in full each month. This eliminates the mental burden of tracking due dates and the financial penalty of late payments. Some people resist autopay because they fear losing control, worrying that companies might charge incorrect amounts or that they won't notice subscription services they are no longer using. These are valid concerns, which is why automation should be paired with regular monitoring. Once a week or once a month, you review your accounts, scanning for anything unusual or unnecessary, but the actual payment happens automatically, protecting you from late fees while still allowing you to maintain oversight. Retirement savings is another crucial area for automation. If your employer offers a 401k with automatic enrollment, they've already done you a favor by setting up the automation. If they offer a match, meaning they contribute money to your retirement account based on your contributions, maximizing that match should be your first priority. It's literally free money, an instant 100% return on your investment. Many employers match 50 cents or even $1 for every dollar you contribute, up to a certain percentage of your salary, typically 3 to 6%. If you don't have access to an employer retirement account, or if you want to save beyond what that account allows, you can open an individual retirement account, an IRA, and set up automatic monthly transfers from your checking account to that IRA. The money then gets automatically invested according to the allocation you've chosen, typically a mix of stock and bond funds appropriate for your age and risk tolerance. The psychological research on automation reveals something interesting. People who automate their savings report less stress about saving. They're not constantly making the decision to save versus spend. They're not feeling guilty about money that should have gone to savings but didn't. The decision was made once, the automation was set up, and now it simply happens. There's a freedom in that delegation, a relief in not having to be vigilant every moment. One powerful automation strategy that's gained popularity in recent years is the roundup method, where purchases are rounded up to the nearest dollar and the difference automatically transferred to savings. If you spend $4.35 on coffee, your account is charged $5 and 65 cents goes to savings. Over time, these micro-contributions add up. More importantly, they create a mental link between spending and saving, ensuring that as money goes out, money also goes to your future. Some people automate their giving as well, setting up recurring donations to causes they care about. This removes the decision fatigue from charitable giving and ensures that generosity remains part of their financial life, even during busy or stressful periods. When you automate what matters, you ensure that it happens regardless of mood, circumstance, or willpower levels on any given day. As you rest here now, picture your future financial life, one where good choices happen automatically. Money flows into savings before you can spend it. Bills get paid on time without effort. Your retirement account grows steadily without requiring constant attention. This isn't some fantasy. It's completely achievable with a few hours of setup and occasional adjustment. The system, once established, runs on its own, freeing your mental and emotional energy for things that matter more than financial logistics. The beauty of automation is that it works with human nature rather than against it. We're not wired for constant vigilance and discipline. We're wired for habits and routines. Automation transforms saving from something that requires discipline into something that's simply a routine, as automatic as breathing. And when saving becomes automatic, it becomes inevitable. You can't fail at something that happens whether you think about it or not. Building your emergency fund, the foundation of financial security. There is a particular kind of stress that comes from living without a financial cushion, a background anxiety that colors everything. It's the stress of knowing that one unexpected expense, one car repair, or medical bill, or loss of work hours could topple everything you've built. This stress affects your health, your relationships, your sleep, your ability to focus at work. It's exhausting and it's invisible to anyone who's never experienced it. An emergency fund is the antidote to this stress. It's not glamorous. It doesn't grow your wealth in dramatic ways, but it provides something far more valuable: security, breathing room, the ability to face unexpected challenges without panic. Research from financial wellness organizations has consistently found that people with emergency savings report significantly lower financial stress, better physical health, better mental health, and greater overall life satisfaction than those without savings. The correlation is that strong. So what is an emergency fund exactly? It's a separate savings account holding enough money to cover your essential expenses for a specific period of time, typically 3 to 6 months. Not your income, but your expenses, because in an emergency you cut back to essentials. You're not maintaining your usual lifestyle. You're covering housing, food, utilities, insurance, transportation, and minimum debt payments. Everything else can wait. The amount needed varies based on your situation. Someone with a stable job, a partner who also works, and minimal dependents might be fine with 3 months of expenses. Someone self-employed with variable income or in an industry with frequent layoffs might need 6 months or even 9 months. Someone with substantial medical expenses or elderly parents they're helping support might need even more. The general guideline of 3 to 6 months is just that, a guideline, not a rigid rule. But let's be honest, even 3 months of expenses sounds impossibly large when you're starting from zero. If your basic monthly expenses are $3,000, 3 months is $9,000. If you've never had more than a few $100s in savings, 9,000 might as well be 9 million. This is where the brilliance of incremental progress comes in. You don't build your emergency fund overnight. You build it dollar by dollar, paycheck by paycheck, month by month. Many financial advisors recommend starting with a smaller, more achievable target: $1,000. Just $1,000. This amount can cover many common emergencies: a car repair, a broken appliance, an urgent trip to see family, and its achievability makes it psychologically powerful. When you hit that first $1,000, you've proven to yourself that you can save. You've created momentum. And momentum in behavior change is everything. From there, you work toward 1 month of expenses, then 2 months, then 3, until you reach whatever target feels right for your circumstances. Some months, you'll contribute more to your emergency fund. Some months, emergencies will actually happen and you'll need to use some of it, which is exactly what it's for. The key is getting back to building it once the crisis passes. Where should you keep your emergency fund? The answer is simpler than you might think. A high-yield savings account at an FDIC-insured bank or credit union high yield because you want your money to grow at least a little through interest. savings account because you need it to be liquid, accessible within a day or two if necessary, but not so accessible that you're tempted to dip into it for non-emergencies FDIC insured because you want zero risk. This is not money for investing or speculating. This is your safety net, and safety nets need to be solid. Some people split their emergency fund across multiple accounts, or even include a small portion in a short-term certificate of deposit that earns slightly higher interest, but can be accessed with a small penalty if absolutely needed. Others keep the entire fund in a single high-yield savings account at a different bank from their checking account, creating a small barrier to access that reduces impulsive withdrawals without making the money truly difficult to get when there's a real emergency. The psychological benefits of having an emergency fund extend far beyond the obvious. When you have savings, you negotiate differently. If your car breaks down and the repair estimate seems inflated, you can get a second opinion without fear that the car will remain broken and you'll lose your way to work. If you lose your job, you can take a few weeks to find something good rather than desperately accepting the first offer. If a family member needs help, you can provide it without wrecking your own finances. The fund creates options, and options create peace. Behavioral economists talk about something called decision bandwidth, the mental energy available for making choices. When you're operating without a financial cushion, a significant portion of your decision bandwidth gets consumed by constant microcalculations and worry. Can I afford this? What if that happens? How will I cover this bill? This cognitive load impairs your ability to make good decisions in all areas of life, not just financial ones. An emergency fund frees up that bandwidth, allowing your brain to focus on things that actually matter. There's also research showing that people with emergency savings are more likely to take positive risks, starting businesses, changing careers, pursuing education, because they have the security to try something new without risking immediate catastrophe if it doesn't work out immediately. The safety net doesn't make you reckless. It makes you brave in the right ways. As you lie here, feeling your body grow heavier, your breathing slower, imagine what it would feel like to have 3 months of expenses sitting in an account you don't touch. Imagine getting a text alert about an unexpected expense and instead of that familiar panic, feeling only mild annoyance because you know you can handle it. Imagine that shift from constant vulnerability to solid ground. That feeling is available to you. It's not years away, it's months away, achievable through consistent, automated saving, and the psychological transformation it creates is worth every dollar. The mathematics of wealth. Understanding compound interest. There's a concept in finance so powerful that Albert Einstein allegedly called it the eighth wonder of the world, though historians debate whether he actually said that regardless of the quote's authenticity, the concept itself is undeniably powerful. Compound interest. Understanding compound interest is understanding how small amounts of money, given time, can become substantial wealth. It's understanding why starting early matters so much, and why consistency matters more than occasional large contributions. Compound interest is often explained as interest on interest, but let's make it more concrete. Imagine you save $1,000 in an account that earns 5% interest annually. At the end of the first year, you earn $50 in interest, bringing your balance to $1,050, simple enough. But in year 2, That 5% applies not to the original 1,000, but to the new total of 1,050. So you earn $52.50. Your balance becomes $1,102.50. This seems like a trivial difference, $2.50. But watch what happens over time. In year 3, you're earning interest on $1,102.50, gaining about $55.13. By year 10, assuming you never add another dollar, your balance has grown to approximately $1,629. By year 20, it's nearly $2,653. By year 30, over $4,300. Same initial 1,000, never touched. Growing purely through compound interest. Now let's make it more realistic. You're not just putting in $1,000 once. You're adding to it regularly. Let's say you save $100 per month, $1,200 per year, in an account earning 5% annual interest. After 10 years, you haven't just saved $12,000, the sum of your contributions. Thanks to compound interest, you have approximately $15,500. After 20 years, the gap widens. You've contributed $24,000, but your balance is over $41,000. After 30 years, your contributions total $36,000, but your balance exceeds $83,000. The money you contributed and the growth from interest are roughly equal at the 30-year mark, but continue to year 40, and the compounding effect truly reveals itself. Your contributions reach $48,000, but your balance is over $152,000. More than $100,000 came not from your contributions, but from the power of compound growth, money earning money, which then earns more money in an ever-accelerating cycle. This is why time matters so profoundly. Someone who starts saving $100 per month at age 25 and continues until age 65 saves a total of $48,000, but ends up with approximately $152,000, assuming a 5% return. Someone who waits until age 35 to start, saving the same $100 per month until 65, contributes $36,000, but ends up with only $83,000. The person who started 10 years earlier contributed just $12,000 more, but ended up with $69,000 more. That's the compound interest advantage of those early years. The math gets even more dramatic with higher returns. The stock market, over the long term, has averaged about 10% annual returns, though with significant volatility along the way. At 10%, that same $100 monthly over 40 years doesn't result in $150,000. It results in over $600,000. Your contributions still total $48,000, but compound growth multiplied it more than 12 times. Now, it's crucial to understand that you won't get 10% every single year. Some years will be fantastic, up 20%. Other years will be terrible, down 10 or 15%. Markets fluctuate. This is why emergency funds and short-term savings belong in safe, liquid accounts earning modest interest, while long-term wealth building happens in investments that can withstand short-term volatility for the sake of long-term growth. The power of compound interest in investments comes from staying invested through the ups and downs, allowing time to smooth out the volatility and the overall upward trajectory to work its magic. Research in behavioral finance has identified several cognitive biases that make it difficult for people to truly grasp compound interest intuitively. We think linearly, not exponentially. We see $100 becoming $105, then $110, and we project forward in straight lines. We don't naturally think in curves that bend upward more steeply over time. This is why compound interest often feels like a mathematical trick, rather than the straightforward consequence of basic principles. There's also something called hyperbolic discounting, the tendency to value immediate rewards much more highly than future rewards. Spending $100 today brings immediate gratification. Saving it for a future that seems abstract and distant doesn't trigger the same pleasure centers. Our brains evolved to prioritize the present because for most of human history, long-term planning beyond the next season wasn't particularly relevant. But now, in an era of extended lifespans and delayed retirement, those evolutionary tendencies work against us. Understanding compound interest intellectually is one thing. Internalizing it emotionally is another. The goal is to reach a place where, when you look at a $100 bill, you see not just what it could buy today, but what it could become over decades. You see not 100, but 163, which is what it becomes in 10 years at 5%, or 265, which is what it becomes in 20 years, or 432, which is what it becomes in 30 years. This shift in perception changes your relationship with spending and saving in profound ways. As you drift here, in this space between waking and sleeping, let these numbers and concepts settle into your deeper consciousness. You don't need to memorize formulas. You simply need to absorb the truth that time and consistency, working together through the power of compounding, create wealth. That the sacrifices you make today, the $100 or $200 or $500 you choose to save rather than spend, those aren't sacrifices at all when you understand their future value. They are investments in a version of yourself who will thank you, who will enjoy security and options and freedom because you understood this principle and acted on it. Breaking the chains of instant gratification. Behavioral economics and spending. Let's talk about why budgeting and saving feel so difficult, even when you understand intellectually that they're important. Let's talk about the gap between knowing what you should do and actually doing it. This gap isn't a character flaw. It's not weakness or lack of discipline. It's the predictable result of how human brains are wired, and understanding the psychology behind our financial behaviors is the first step toward changing them. Behavioral economics, a field that combines psychology and economics, has revealed that humans are magnificently irrational when it comes to money. We make decisions based on emotion rather than logic. We value things differently depending on how they are framed. We're heavily influenced by factors we don't even consciously register. Traditional economics assumed people were rational actors who made optimal decisions based on available information. But decades of research have proven that assumption laughably wrong. One of the most powerful cognitive biases affecting financial behavior is present bias, the tendency to give greater weight to immediate payoffs than to future ones. This is closely related to hyperbolic discounting, which we touched on earlier. Essentially, your brain treats future you almost like a different person, someone whose needs and desires feel abstract and unimportant compared to the vivid, pressing desires of present you. The pleasure of buying something right now is concrete and guaranteed. The benefits of saving that money are distant and theoretical. This explains why people with good intentions find themselves spending money they meant to save. In the morning, you're thinking about your long-term goals, your future security, your plans to build an emergency fund. Future you seems important and worthy of sacrifice. But by evening, after a stressful day, when you're standing in a store or scrolling through a shopping app, future you has faded into abstraction, and present you really wants that thing right there. Present you wins. This happens not because you're weak, but because present bias is a fundamental feature of human cognition. Another powerful bias is loss aversion, the principle that losses hurt roughly twice as much as gains feel good. We feel more pain from losing $20 than pleasure from gaining $20. This affects saving in interesting ways. The act of saving feels like a loss because the money is leaving your immediate control, even though rationally you know it's still yours, just in a different account. The act of spending feels like a gain because you're getting something. Even though rationally you're losing money, our emotional systems are responding to the wrong signals, treating saving as loss and spending as gain, when from a long-term perspective it's the opposite. Mental accounting, another key concept in behavioral economics, refers to how we categorize money differently based on its source or intended use. Money from a paycheck might feel different from money from a tax refund or a birthday gift. We might be frugal with earned income, but frivolous with windfall income, even though money is fungible, meaning a dollar is a dollar, regardless of where it came from. Similarly, we might feel fine about putting a vacation on a credit card but would never consider borrowing money to buy groceries, even though both are debt. The mental categories feel different, so we apply different standards. Understanding these biases doesn't make them disappear, but it does allow you to design systems that work around them, if present. Bias makes it hard to save. Automation solves that by moving money to savings before present, you get a chance to spend it. If loss aversion makes saving feel painful, reframing helps. You're not losing money. You're paying your future self, or you're buying future freedom. If mental accounting leads to treating windfalls irresponsibly, you can create a rule. Half to fun, half to savings, making conscious what would otherwise be unconscious. There's also the phenomenon of decision fatigue, where the quality of your decisions deteriorates after making many choices. By the end of a day filled with decisions, your ability to exercise self-control is depleted. This is why you're more likely to impulse buy in the evening than in the morning, why that second glass of wine or that late-night online shopping session happens when it does. Your prefrontal cortex, the part of your brain responsible for future-oriented thinking and self-regulation, is tired. The more primitive parts of your brain, focused on immediate rewards, take over. The antidote to decision fatigue, again, is reducing the number of decisions you need to make. Automation, default choices, pre-commitment strategies. If your budget is already set, your savings are already allocated, your bills are already scheduled to pay, then most of the financial decisions are already made. You're not relying on in-the-moment willpower. You're relying on systems you set up when your prefrontal cortex was fresh and focused. anchoring is another cognitive bias worth understanding. We tend to rely heavily on the first piece of information we encounter when making decisions. If you see a jacket originally priced at $300 now on sale for $150, the 300 anchors your perception, making $150 seem like a great deal, even if the jacket is only worth $50. Retailers know this and use it constantly. Being aware of anchoring helps you ask better questions. What is this actually worth to me, independent of any reference points? Does the price align with my values and budget, regardless of what it supposedly cost before or what other similar items cost? There was also the sunk cost fallacy, the tendency to continue investing in something because you've already invested in it, even when continuing makes no sense. You keep paying for a gym membership you never use because you already paid for 6 months. You finish a meal you're no longer enjoying because you paid for it. You stay in an expensive subscription service because you've been in it for years. The rational approach is to make decisions based on current and future costs and benefits, ignoring sunk costs because they're gone regardless. But emotionally, this is difficult. We hate admitting that past investments were wasted, so we throw good money after bad. Recognizing these patterns in your own behavior isn't about self-judgment, it's about self-understanding. When you find yourself about to make a purchase you didn't plan for, you can pause and ask, is this present bias talking? Is this decision fatigue? Am I being anchored by some arbitrary reference price? This moment of awareness often breaks the automatic response, giving you space to make a different choice. As you rest here, these concepts are settling into your mind, becoming part of your mental toolkit. Tomorrow, and in the days and weeks ahead, when you face financial decisions, these understandings will be there, quietly influencing your choices in positive directions. You don't need to consciously remember the terms. You just need to have absorbed the insights, which will manifest as pauses, questions, better choices, creating your personalized savings architecture. Every person's financial situation is unique. Different incomes, different expenses, different goals, different timelines, different challenges. So while the principles of budgeting and saving remain consistent, the specific application needs to be tailored to your life. Let's explore how to create a saving system that works for you, specifically, that accounts for your circumstances and grows with you as those circumstances change. The first element of a personalized system is clarity about your goals, not vague wishes like save more money or be financially secure, but specific tangible goals with numbers and timelines. What exactly are you saving for? When do you need this money? How much will you need? Break large goals into smaller milestones that feel achievable. Instead of save for retirement, maybe it's contribute $5,000 to my retirement account this year. Instead of build an emergency fund, maybe it's save $1,000 in the next 6 months. Having multiple goals simultaneously is normal and healthy, but trying to fund all of them equally often leads to making inadequate progress on all of them. Prioritization matters. Most financial advisors suggest this hierarchy. First, establish a small emergency fund of $1,000. Second, pay off high-interest debt, anything above 7 or 8% interest, because that debt is costing you more than most investments would earn you. Third, build your emergency fund to 3 to 6 months of expenses. Fourth, maximize employer retirement matching, that free money we discussed earlier. Fifth, work on additional goals like saving for a house down payment, paying off lower interest debt, increasing retirement contributions beyond the match. This isn't the only possible priority sequence, but it reflects solid reasoning based on mathematical return and risk reduction. The small emergency fund prevents needing to go into debt for minor crises while you're paying off existing debt. High interest debt is addressed early because it's wealth destroying. The full emergency fund provides stability. Employer matching is free money too valuable to pass up. Everything else comes after these foundations are in place. Within your broader savings goals, consider using multiple accounts designated for different purposes. This leverages mental accounting, that behavioral economics concept, in your favor. Instead of one generic savings account where everything blends together, you have separate buckets: emergency fund, vacation fund, car replacement fund, house down payment fund. Many banks allow you to create sub-accounts within your savings account, each with its own label and balance. Seeing these separate amounts makes each goal more concrete, more real. This also prevents the problem of raiding savings meant for one purpose to fund another. If all your savings sit in one account, it's easy to justify dipping into it for anything. But if you see that taking $200 means it's coming from your emergency fund specifically, that creates psychological friction that might prevent the withdrawal, or at least make you think harder about whether it's truly necessary. For planned irregular expenses, things you know are coming but don't happen monthly, sinking funds are powerful. A sinking fund is money you set aside regularly for expenses that occur occasionally. Car insurance might be due twice a year. Instead of scrambling to find $600 when it's due, you save $50 per month into a car insurance sinking fund. When the bill arrives, the money is there waiting. Same for property taxes, annual subscription renewals, holiday gifts, car maintenance, whatever expenses don't fit neatly into your monthly budget. The beauty of sinking funds is they transform irregular expenses from crises into non-events. You're not stressed when your car registration comes due, or when your kid needs school supplies because the money was already allocated. This reduces financial stress dramatically and prevents the cycle of putting irregular expenses on credit cards, then paying interest because you can't pay the card off immediately. Your savings system should also account for income variability if that's part of your situation. If you're self-employed, work on commission, or have seasonal employment, your income fluctuates, making traditional budgeting challenging. In these cases, some people use a baseline budgeting approach where you identify your minimum monthly income, the amount you can count on even in slower months, and build your budget around that. Anything beyond the baseline in good months gets divided according to a predetermined formula. Perhaps 75% to savings and goals, 25% to discretionary spending or additional debt payment. This prevents the feast or famine cycle where high-earning months lead to high spending, leaving nothing for lean months. It also ensures that higher income translates to wealth building rather than lifestyle inflation, that phenomenon where expenses rise to meet income, keeping you perpetually broke, no matter how much you earn. For couples managing finances together, The architecture gets more complex because now you're aligning two people's habits, values, and goals. Some couples merge everything, sharing all accounts and making all decisions jointly. Others keep everything separate, splitting shared expenses according to some agreed-upon formula. Most fall somewhere in between, with shared accounts for shared expenses and individual accounts for personal spending. There's no universally right answer. What matters is finding an arrangement both people feel good about, having regular money conversations to ensure you're still aligned, and adjusting the system as circumstances change. One often overlooked element of a savings system is review and adjustment. Your budget and savings goals shouldn't be static. Life changes, income changes, expenses change, goals change. Schedule a money date with yourself monthly or quarterly to review your system. What's working? What's not? Where are you consistently over or under budget? Have your goals shifted? Is there a category you need to add or eliminate? This regular check-in prevents your system from becoming obsolete and keeps you engaged with your finances in a healthy, proactive way. Rather than only thinking about money when there's a problem, technology can support your system enormously. Budgeting apps can track spending automatically, categorize transactions, and alert you when you're approaching category limits. Savings apps can automate transfers and even invest small amounts on your behalf. But technology is a tool, not a solution. The best app in the world won't fix underlying behavioral issues or lack of clear goals. Start with clarity about what you want to achieve and why. Then select tools that support your specific system. As you lie here, imagine your ideal financial system, one that fits your life perfectly, that makes saving feel natural, that aligns with your values. See it in your mind, not in exhaustive detail, but in broad strokes. See yourself checking in on it regularly, making small adjustments, celebrating progress. See your future self benefiting from the system you're building now, living with less stress, more options, greater security. This vision, held loosely in your subconscious, will guide your actions more powerfully than any rigid plan could. The overnight reprogramming process, rewiring your financial brain. We've covered a lot of ground tonight, exploring the psychology of money, the mechanics of budgeting, the power of automation and compound interest, the behavioral traps that lead us astray. But information alone doesn't change behavior. If it did, everyone who's read a financial book or attended a budgeting workshop would be wealthy. Knowledge is necessary, but insufficient. What creates change is the deeper integration of that knowledge, the reprogramming of automatic responses and unconscious beliefs. This is where the overnight training aspect comes in, where the specific practice of absorbing financial wisdom while in a relaxed or sleeping state becomes powerful. During sleep, particularly during certain stages of sleep, the brain consolidates memories, processes, emotional experiences, and integrates new information with existing knowledge. This is why students are advised to review material before bed when studying for exams. The sleeping brain continues working on what it encountered before sleep, strengthening neural pathways, making connections, solidifying learning. The same principle applies to financial habits and beliefs. By spending this time before sleep immersed in concepts about healthy money management, abundance mindset, and strategic saving, you're priming your brain to process and integrate these concepts overnight. The relaxed state you're in right now with your body still and your conscious mind drifting, is actually ideal for learning at a deeper level because your usual mental defenses and skepticisms are quieted. Information can reach the subconscious more directly. Affirmations and visualization, practices sometimes dismissed as New Age nonsense, actually have solid neurological basis. When you repeatedly think a thought, you strengthen the neural pathway associated with that thought. When you visualize a scenario, your brain activates many of the same regions as if you were actually experiencing that scenario. Athletes use visualization to improve performance. Therapy clients use it to overcome phobias and anxiety. You can use it to reshape your financial identity and habits. Consider crafting several financial affirmations, short, positive statements that align with the identity and behaviors you want to cultivate. I am capable of managing money wisely. I prioritize my future security through consistent saving. I make thoughtful financial decisions aligned with my values. I trust myself to build wealth steadily over time. The exact wording matters less than finding phrases that resonate with you, that feel both aspirational and believable. Repeat these affirmations during your relaxed state before sleep, or let them play in your mind as you drift off. Don't focus on forcing belief. Just let the words wash over you, like gentle waves lapping at a shore. Over time, with repetition, these statements begin to feel more true. Not through magical thinking, but through the simple neurological fact that what we repeatedly think becomes familiar, and familiar begins to feel true. This shifts your identity from someone who struggles with money to someone who manages it well, and behavior follows identity. Visualization works similarly. Spend a few minutes each night, or as you're falling asleep, visualizing your ideal financial future. Not in vague fantasy terms, but with specific sensory details. See yourself checking your bank account and feeling satisfied with the balances. See yourself making a planned purchase without guilt because it's within your budget and aligned with your values. See yourself in retirement, secure and comfortable because you saved consistently throughout your working years. Feel the emotions associated with these scenarios: peace, satisfaction, pride, security. Your brain, processing these visualizations, begins to treat them as experiences, strengthening the neural patterns associated with financial success. This isn't about pretending challenges don't exist or denying current struggles. It's about giving your brain a clear target to move toward, a destination to navigate toward even when the path isn't perfectly clear. The concept of neuroplasticity is central here. For decades, scientists believed the adult brain was essentially fixed, that neural patterns established in youth remained largely unchanged throughout life. But research over the past few decades has demolished that assumption. The brain remains plastic, capable of forming new connections and pathways throughout life. This means old habits can be unlearned and new habits established, regardless of your age or how long you've struggled with money. But neuroplasticity requires two things: attention and repetition. You need to focus attention on the new pattern you want to establish, and you need to repeat it consistently until it becomes automatic. This is why overnight training, done regularly, becomes powerful. Each night, you're directing attention to healthy financial concepts and behaviors. Each night, you're repeating that focus. Over weeks and months, new patterns solidify, old patterns weaken, and your relationship with money transforms. There's also the element of self-compassion in this process. Financial reprogramming isn't about berating yourself for past mistakes or forcing yourself through rigid discipline. It's about gentle, persistent movement in a positive direction. You'll have setbacks. You'll make impulse purchases. You'll have months where you save less than planned, or even need to dip into savings. This is normal, part of being human. The measure of success isn't perfection. It's the trend line, the overall direction, the slow accumulation of better choices that, compounded over time, create a transformed financial life. Research in habit formation suggests it takes somewhere between 18 days and 254 days for a new behavior to become automatic, depending on the complexity of the behavior and individual factors. The commonly cited 21 days is oversimplified and often inaccurate. But the key takeaway is that habit formation takes consistent effort over time, measured in weeks and months, not days. This is why overnight training is framed as training, not instant transformation. You're engaging in a practice that, repeated nightly, creates cumulative change. As you rest here now, in this liminal space between waking and sleeping, know that this time isn't wasted or indulgent. It's productive in the truest sense, allowing your mind to process, integrate, and reshape itself. The work is happening quietly, beneath conscious awareness. Tomorrow morning, you might not feel dramatically different. But over time, you'll notice changes. Different responses to spending temptations. Greater ease around financial conversations, increased confidence in your ability to manage money, a shift from scarcity to abundance in your default perspective, advanced strategies for accelerating wealth building. Once you've established the basics, the emergency fund, the budget, the automated savings, there are additional strategies that can accelerate your wealth building. Those aren't essential when you're first starting out. But as your financial foundation solidifies, they become relevant and powerful. Tax-advantaged accounts represent one of the most significant opportunities for wealth acceleration. We've mentioned retirement accounts, 401ks and IRAs, but let's understand what makes them so valuable. These accounts offer tax benefits that dramatically increase their effectiveness compared to taxable accounts. A traditional 401k or IRA reduces your taxable income in the year you contribute, meaning if you earn $60,000 and contribute $5,000 to your 401k, you're only taxed on $55,000. That's an immediate return equal to your marginal tax rate, perhaps 22%. So $5,000 contributed costs you only $3,900 in after-tax dollars. The money then grows tax-free within the account, meaning you pay no taxes on interest, dividends, or capital gains along the way. Only when you withdraw in retirement do you pay taxes, and if you're in a lower tax bracket in retirement than during your working years, which many people are, you've saved significantly. A Roth 401k or Roth IRA works differently, offering no tax benefit up front but allowing completely tax-free withdrawals in retirement, which can be incredibly valuable if you expect to be in a higher tax bracket later, or if you want to avoid required minimum distributions that apply to traditional accounts. Health savings accounts, HSAs, offer what's sometimes called triple tax advantage. Contributions reduce your taxable income, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. If you have a high-deductible health insurance plan, which is a requirement for HSA eligibility. Maximizing your HSA contributions should be a priority. After age 65, you can withdraw for any reason without penalty, though you'll pay taxes on non-medical withdrawals just like with a traditional IRA. Many people use HSAs as additional retirement savings vehicles, paying medical expenses out of pocket when possible, and allowing the HSA to grow. 529 college savings plans offer similar tax benefits for education expenses. While contributions aren't federally deductible, many states offer state tax deductions or credits. Growth is tax-free, and withdrawals for qualified education expenses are tax-free. Given the high cost of education, using a 529 instead of a taxable savings account for college savings can result in thousands of dollars in additional available funds. The common thread among these accounts is using the tax code to your advantage. The government incentivizes certain behaviors like saving for retirement, healthcare, and education by offering tax benefits. Not taking advantage of these benefits means leaving money on the table, paying more in taxes than necessary, and growing wealth more slowly than possible. Another advanced strategy involves optimizing the balance between saving and debt payoff. The simple rule is to pay off high-interest debt first, because the interest you're paying exceeds what you could earn through investing. But for lower interest debt, like a mortgage at 3% or 4%, the math becomes less clear. If your investments could reasonably earn 7 or 8%, you're better off investing than accelerating mortgage payoff. But this doesn't account for the psychological benefit of being debt-free, which for many people outweighs the mathematical advantage of investing. The optimal approach often involves a both-and strategy. Meet your employer match in retirement accounts, maintain your emergency fund, pay minimums on all debts, then split any remaining available money between extra debt payments and additional investing according to whatever ratio feels right for your risk tolerance and psychological comfort. Some people prefer the guaranteed return of debt elimination. Others prefer building assets that can appreciate. Both are valid. As your income increases over time, whether through raises, promotions, or career changes, lifestyle inflation becomes a major risk. Lifestyle inflation is the tendency for spending to increase in lockstep with income, so that even as you earn more, you never seem to have more left over. The person earning $40,000 feels broke. They get a raise to $60,000 and initially feel rich, but within months, spending has risen to meet the new income, and they feel broke again at $60,000. This pattern can continue up to incomes in the hundreds of thousands, with people earning impressive salaries still living paycheck to paycheck. The counter to lifestyle inflation is consciously directing income increases to savings before allowing any lifestyle expansion. If you get a $3,000 raise, increase your automatic retirement contributions by $2,000 annually before you see that money in your checking account. Allow yourself $1,000 to enjoy, perhaps putting it toward a category you've felt constrained in, but lock in the majority for savings before your spending patterns adjust. This keeps lifestyle creep gradual while allowing savings to accelerate dramatically. Dollar cost averaging is an investment strategy particularly relevant for building wealth through market investments, rather than trying to time the market, buying low and selling high, which very few people can do consistently. You invest a fixed amount. at regular intervals regardless of market conditions. When prices are high, your fixed amount buys fewer shares. When prices are low, it buys more shares. Over time, this averages out your purchase price and eliminates the anxiety and guesswork of trying to time investments perfectly. This strategy works beautifully with automated investing, where a set amount transfers from your bank account to your investment account monthly and purchases a predetermined selection of funds. You're not making active decisions, not worrying about whether now is a good time to invest. The system simply runs, accumulating shares steadily, taking advantage of market dips without trying to predict them. Rebalancing is another important concept as your investments grow. Over time, different assets in your portfolio grow at different rates, causing your allocation to drift from your intended mix. If you wanted 60% stocks and 40% bonds, but stocks have grown faster, you might now have 70% stocks and 30% bonds. Rebalancing involves selling some of the overweighted asset and buying more of the underweighted asset, returning to your target allocation. This seems counterintuitive. Selling the winner to buy more of the laggard, but it enforces a buy low, sell high discipline and maintains your intended risk level. As you approach major financial goals like retirement, your strategy shifts from accumulation to preservation and income generation. This typically means reducing exposure to volatile assets like stocks and increasing allocation to stable, income-producing assets like bonds. The exact timing and degree of this shift depends on your specific circumstances, risk tolerance, and retirement timeline, which is why working with a financial advisor becomes increasingly valuable as your financial life grows more complex. All of these advanced strategies build on the foundation we've established throughout this overnight training. They're not relevant if you don't have that foundation, the budget, the emergency fund, the automated savings. But once you do, these additional layers can significantly accelerate your wealth building and optimize your financial outcomes. And the beautiful thing is that many of these strategies, once set up, run on autopilot just like your basic savings automation, requiring only occasional review and adjustment. Integration. Bringing it all together. We've covered a tremendous amount tonight, traveling from the psychological roots of your money beliefs through the practical mechanics of budgeting, automation, and wealth building. Now, as we near the end of this session, let's bring it all together into a cohesive vision of your transformed financial life. Imagine waking tomorrow morning, not with anxiety about money, but with calm confidence. You know where you stand financially because you have a budget that actually reflects your reality. You know your money is working for you because automation ensures that savings happens before spending. You know you're prepared for emergencies because your emergency fund is growing steadily. You know your future is being built because your retirement accounts are accumulating, compounding quietly in the background. This isn't fantasy. This is completely achievable, not through dramatic overnight change, but through consistent small actions that, maintained over weeks and months and years, create profound transformation. The person who saves $100 per paycheck, every paycheck, for years, ends up in a completely different place than the person who saves nothing. Even if those two people started with identical incomes and circumstances, your financial journey won't be linear. There will be setbacks, months where you save less than planned or even nothing, emergency expenses that require using savings, unexpected job changes or life events that disrupt your system. This is normal. Life is messy. What matters is the overall trajectory, the commitment to returning to your plan after disruptions, the long-term consistency that allows compound interest and good habits to work their magic. Start tomorrow with one small action. Maybe it's opening a high-yield savings account. Maybe it's setting up one automatic transfer, even if it's just $25. Maybe it's tracking your spending for a week to understand where your money currently goes. Maybe it's sitting down and defining one specific savings goal with a number and a timeline. Whatever feels manageable, do that. Then build from there. Remember that your relationship with money is just that, a relationship. Like any relationship, it requires attention, care, communication, and occasional repair when things go off track. Give yourself permission to be imperfect at this. Give yourself credit for effort even when outcomes aren't yet where you want them. Celebrate small wins. The first month you stick to your budget, the day your emergency fund hits $1,000, the moment you realize you made a spending choice consciously rather than impulsively. The concepts we've explored tonight, the psychological insights, the practical strategies, the mathematical principles, these are now part of you, settling into your subconscious, ready to surface when you need them. You might not remember everything consciously, and that's fine. Trust that the important changes are happening beneath awareness, reshaping your habits and beliefs in gentle, lasting ways. Financial transformation isn't about deprivation or misery. It's about alignment, ensuring your money reflects your values and supports your genuine priorities. It's about freedom, reducing the stress and limitation that financial chaos creates. It's about self-respect, treating your future self with the same care and consideration you'd give to someone you love. Because future you is someone you'll eventually become, and they deserve the gift of your current planning and sacrifice. As you drift deeper now into whatever comes next, whether continued wakefulness or deep sleep, let these final thoughts anchor themselves in your mind. You are capable of this. Financial wellness is available to you. The skills and knowledge you need can be learned, and you're already learning them. Change happens gradually, but it happens. And you're beginning that change right now, in this moment, through this practice. Tomorrow morning, you'll wake as someone slightly different, someone who's taken in these concepts, someone whose financial future is a little brighter than it was yesterday. And tomorrow night, if you return to this training, you'll reinforce these patterns further. Night by night, choice by choice, dollar by dollar, your financial life will transform. Trust the process. Trust yourself. A peaceful closing. The night is yours now, and so is your future. We've journeyed together through the landscape of money and mind, exploring how they intersect, how they can be brought into harmony. As you lie here in the quiet, your body fully relaxed, your mind growing quieter, know that you've done something valuable tonight. You've invested in yourself, in your understanding, in your future. Let go of any remaining tension, let go of any worry about whether you remember everything or whether you're doing this right. There's no right or wrong. There's only attention, only presence, only the gentle absorption of ideas that will serve you well. Your breathing is slow and steady, deep and easy. Your body is heavy and comfortable. Your mind is drifting, floating, and that's exactly perfect. The unconscious processing will continue while you sleep, integrating what you've learned, creating new neural pathways, building new habits at a level deeper than conscious thought. Tomorrow is a new day, a fresh start, an opportunity to take one small step toward the financial life you want. And the day after that, another step. And the day after that, another. Each small step, each good choice, each dollar saved, these accumulate like drops of water filling a bucket, individually insignificant, collectively transformative. Sleep well, knowing you're on a path toward greater financial security, reduced stress, increased options, and the peace that comes from knowing you're prepared for whatever life brings. Sleep well, knowing that change is already underway, that tomorrow's you will be slightly different than today's, slightly more capable, slightly more confident. If you found this training valuable, if these concepts resonated, if you feel you'd benefit from more content like this, I'd be grateful if you'd take a moment to like this video and subscribe to the channel Finance Dream Studio exists to help people like you build better relationships with money, to provide information and perspective that serves your financial well-being. Your support through likes and subscriptions helps this content reach more people who need it, and I appreciate you being part of this community. Now let everything go. Let your mind fully release into rest. Whether you continue listening or drift into sleep, know that you're exactly where you need to be, doing exactly what you need to do. The night is peaceful, the future is bright, and you have everything you need to create the financial life you deserve. Good night and sleep well.